It's Britain's newest financial scandal, and it could cost the banks over £11 billion. Behind every handshake at a car showroom, behind every low monthly payment deal, there was a secret, one that made dealerships rich and drivers poorer. For years, British banks and car dealers profited from a commission system that quietly inflated your car loan interest without you ever knowing. This is the Dirty Pound, and today we expose how UK banks scammed drivers out of billions.
Between 2014 and 2020, millions of UK drivers signed up for personal contract purchase agreements, better known as PCPs. They promised flexibility, small deposits, easy upgrades, low monthly payments. But buried in the fine print was a toxic incentive. Dealers could adjust the interest rate on your finance deal, not based on your credit score, but based on how much profit they wanted to make. The higher your rate, the higher their commission. It was all legal at the time, but entirely unethical.
This wasn't a few rogue dealerships. The problem stretched all the way to the top. Major lenders like Lloyds, Barclays, Black Horse Finance, and Close Brothers. For years, they allowed, and even encouraged, commission-based sales that put profit before fairness. According to the Financial Conduct Authority, this created a market rife with conflicts of interest. Lloyds Banking Group alone faces potential compensation bills exceeding £2 billion. Close Brothers Financial Group has already warned investors that its profits could be wiped out.
Behind these numbers are ordinary people.
Emma, a nurse from Manchester, financed her first car in 2017. She later discovered she'd paid £3,200 more in hidden interest, all to fund a dealer's secret commission. Across the country, more than 3 million car finance agreements are now under review. Consumer advocates are calling it PPI 2.0, a scandal of similar scale built on deception and corporate greed. Here's how it worked. You walk into a dealership. The bank offers the dealer a base interest rate, but the dealer is allowed to raise it, say from 6% to 10%, and take the difference as commission. You sign the deal, thinking it's fixed. The dealer collects their bonus, the bank gets the loan, and you're stuck with inflated payments for years. It was known as a discretionary commission arrangement, perfectly normal on paper, perfectly profitable in practice. It wasn't until 2021 that the FCA finally banned these commission schemes. By then, billions had already been pocketed. In 2025, the Financial Conduct Authority concluded its largest ever review of the motor finance industry. The verdict was damning. Lenders and dealers failed to act in the best interest of customers. The regulator ordered a redress scheme, up to £11 billion in compensation for drivers overcharged between 2014 and 2020. It's now one of the largest consumer repayments in British financial history, second only to the PPI scandal. But the consequences go beyond car loans. The scandal has shaken public trust in banks, dealerships, and regulators. Car sales are falling, compliance costs are rising, and millions now question whether the financial system truly serves the public or itself. Once again, Britain is left paying the price for corporate manipulation hiding in plain sight. You've been watching The Dirty Pound, where AI journalism exposes Britain's hidden economy. If you found this investigation useful, subscribe and follow our journey as we uncover the truth behind money, power, and deception in the UK. Next episode, inside the £266 million money laundering network. How dirty cash flows through London's luxury market. Until next time, follow the money.